Bumper payrolls put pay to overblown hopes around the Fed, at least for today. Welcome to Market Insight. I'm David Pollard. The US labour market not as loose as some betting on Fed rate cuts in September had hoped. That's the possible conclusion of today's US jobs report. They showed new payrolls at a far higher than forecast, 272,000 in May. Also above expectations were average hourly earnings, with a 0.4% rise on the month. Well, joining me now is Aaron Anderson, Senior Vice President of Research at Fisher Investments. Welcome, Aaron. These numbers come in a week of mostly softer labour market data in the ADP and JOLTS report, so why the surprise?
I think you said it perfectly. The surprise was all the data earlier this week had been pointing to maybe weakening conditions, and then this was such a strong number. But I would say, all the individual data points here can be quite variable. I mean, they've got big error bands around them. They're always subject to big revisions. I always think the trajectory of these numbers is most important. And I think what they say is that the economy is still relatively healthy. Labor markets are still relatively strong. And so the economy seems to be in good shape to me. But as you said, I think the way the market tends to interpret these things is, what does this mean for the Fed? Which is interesting to me because the implication there is that monetary policy is so critically important to keeping the economy going or keeping this bull market and equities going. And yet we've had a good market, we've had a good economy with interest rates right where they are. And so I think what you're seeing in terms of the interpretation of these things is really, to me, the most interesting point, because what it says is the market right now is more focused on what the Fed is doing than the actual state of the economy, when the actual state of the economy is quite good. And so I think the market just for a long time now has been too focused on monetary policy as such a key driver of the economy and markets, when in fact I would argue it really isn't.
But if we look in detail at today's jobs report, where do markets fear there is strength in the US jobs market, and where do they fear that there are cracks in the jobs market?
Yeah, well, I think you're continuing to see a lot of strength in services, of course, although I'll note that the labor force participation rate did fall a little bit today. It wasn't all rosy in this jobs report, a little bit of conflict between the various data points. The unemployment rate ticked up a very little bit, and yet we had a whole lot of new jobs created. Still, I think it's easy to say that it's services that is one point of optimism, because that is where a lot of the new job growth is coming from, but two, probably a point of concern for folks who are worried that a very strong labor market within the services sectors is going to drive more wage growth, and that's going to drive more inflation. I don't think that's the case, though. I think what you've seen now is that inflation, although it's been a little bit rockier here recently, has mostly been on a decelerating trend, despite a very healthy labor market and pretty decent jobs growth to this point. And so I think that relationship between the two actually isn't quite that strong. There is a relationship there, but it's not a very strong relationship.
But nonetheless, we do have super strong services in the US. We saw that in data this week. And some components in the CPI readings are also super strong, particularly shelter. So does that not complicate the view of where the Fed is going to go from here?
I think it does a little bit, yes. One, I would say it just tells you there's no real need for the Fed to do much of anything dramatic. The economy is in reasonably good shape, so there's no need for them to be cutting very aggressively. And yet you still do have some inflationary pressures out there, which suggests that they might want to keep interest rates a little bit higher for a little bit longer. But I think what's most interesting to me is now we're quibbling about a few basis points of cuts or maybe hikes. I don't think we'll get hikes, but the changes that we're discussing here and the market seems to be worried about are so minor relative to what we've been through already. And the timing, really, whether it happens middle of this year, end of this year, beginning of next year, we've already been through a fairly long stretch of big changes in monetary policy of an order of magnitude bigger than anything that is really being contemplated right now. And so this fixation on pretty small monetary policy changes is what is very interesting to me, and I think a bit of a misperception from the marketplace. I think whether or not we get 1, 2, 3 cuts this year, or we don't get any this year, and maybe they get pushed off to next year, I just don't think that matters all that much. Now, you mentioned shelter. I do think that that's one area that's likely to show some improvement before too long in inflation that should help bring headline numbers down, because we've got such a weird shelter component to our inflation data, the owner's equivalent rent, which is not an actual transaction. If you look at actual transactions, they're still healthy, but they've been on a decelerating trend in terms of home price growth and actual rental costs. but it's this owner's equivalent rent component that seems to be buoying the inflation, the shelter component of inflation. I think that should follow on a downward trend before too long here.
So amid all that, Wall Street has been hitting record highs, much of that on optimism over tech and especially AI. Have we seen the best of the rally for this year, do you think?
I don't think so. Well, I don't want to project that we're going to just continue to get these consistent gains like we've seen. We probably will see some volatility, despite everything I said about politics. There is always the potential for that to add a little bit of uncertainty and volatility to markets. So I don't want to suggest that things are just going to head on a straight line upward from here. But I do think the bull market ought to continue. You know, there's the old saying, bull markets climb a wall of worry, and clearly there's still a lot of worry out there, whether it's related to politics or whether it's related to monetary policy or geopolitics. And so I think what you're seeing here is a fairly normal bull market that's had a few fits and starts, but is generally heading in a positive trajectory. And so I think it'll continue to do that through the end of the year, maybe with not some of the very robust gains that we saw at the very beginning of this year in the first quarter, but I think the general trajectory ought to be higher. But what I do think you'll start to see, you mentioned AI and some of the real big beneficiaries of that enthusiasm this year. I think you're going to start to see leadership broaden out a little bit. Already you've seen some of that. It's not just about technology. It's not just about semiconductors. Energy's had a pretty good year. Financials have had a pretty good year. Industrials have had a decent year. Even utilities, believe it or not, in a year where interest rates have risen a little bit and markets have been strong, utilities have been a decent performer. And so I think you're starting to see more broad-based participation in this market. So AI is a positive thing. I think those companies still have some tailwinds behind them, but I think there are opportunities out there beyond just the direct AI plays.
Aaron, we'll leave it there. Aaron Anderson, Senior Vice President of Research at Fisher Investments. Many thanks for sharing your thoughts with us today. That is Market Insight. Don't forget we have more videos on Reuters.com.